It's true. Across the globe, women aren't as prosperous as men. Gender inequality is a pressing moral issue, but we forget it has massive economic implications. If you were to put all of the women who don't have access to formal financial services in one place, they would make up the third largest country in the world. That means an entire population without bank accounts, credit cards, or other tools you and I likely benefit from daily. Prosperity for women starts with inclusive policies, products, and people around the globe, and the investment to make it happen. Welcome to the Making Finance Work for Women podcast. My name is Sonia Kelly, and I lead Women's World Banking's proprietary research division. Join me as I speak with changemakers around the globe to deconstruct the social and economic exclusion women face. We'll discover new evidence together and drive action to accelerate women's economic empowerment. Because a leg up isn't a handout, it's a global game changer. Indeed. Welcome, and thank you so much for tuning in to the Making Finance Work for Women podcast, now streaming on YouTube and available wherever you get your podcasts. If you're listening on YouTube, you'll be able to find additional insights and resources linked in the description of the video below. I'm the host of the show, Sonia Kelly, and the global head of the Women's World Banking Institute. Before we get started, I'd love to give a special shout out to the sponsor of the Making Finance Work for Women podcast, Ernst & Young LLP. EY is a global leader working across assurance, consulting, law, strategy, tax, and transactions. EY teams ask better questions to find new answers for the complex issues facing our world today. You can visit ey.com to explore their latest insights and services. Let's jump into the show. I don't know if you've noticed, but we've been on a bit of a theme lately looking at innovations in credit for women. We discussed innovations in credit scoring using alternative and available data. We talked about how one company is providing credit to enable women's access to mobile phones and the impact that had on women's economic activity. And we're going to turn today to discussing the impact of what we call productive credit on women's resources and agency. Now, productive credit is a bit of a term of art that we in the industry use to describe credit that's intended to support a person's business or, quote, productive activities as opposed to their consumption activities. So here's a really basic example of a person who maybe has a business and uses productive credit to expand their business. Actually, let me use a real example. There's a woman who lives in Ghana. She has a tailoring business. I actually once placed an order with her for a dress one afternoon, and she made it and brought it to my hotel the next day after taking my measurements. So I have this specific woman in mind. This woman is always busy, but she's really limited by the fact that she has only 2 sewing machines. Labor, like hiring people, is not a problem for her, but her capacity to produce things is really limited by her actual equipment. So this woman thinks, if I could only have one more sewing machine and hire another worker, I could make 50% more profit. So let's say this woman gets a loan for the additional sewing machine and is able to expand her business. This is productive credit. Now, I'm not saying her story is representative, but it's a demonstration of what productive credit might look like at its best. And then we need to be thinking about what that productive credit does for her, what it does for her business, what it does for her agency, what it does for her in terms of her position in her community, her ability to send her kids to school, her negotiating power with her partner in her household. Now, I remember very, very well, nearly 2 decades ago, when economists started turning their focus to credit. And they started conducting these very rigorous evaluations of what kinds of credit products, in what kinds of contexts were helpful in creating women's economic empowerment, in creating jobs, and even in creating the economic growth of entire communities. Now, at that time, 2 decades ago, the evidence was mixed, And it told us that not all credit is helpful to not all people. This was important data because it gave us some really good clues that have since shaped the credit space and pushed the financial services industry to innovate if we actually want to make a positive difference in people's lives. If I could summarize the literature from the past 2 decades, it would read like this. First of all, does credit increase women's economic empowerment? Not always. Well, then, in what circumstances does it increase economic empowerment? And here's where the literature gives us some really important clues that help us with product design. And then the third question, what are credit's other benefits like job creation, economic growth, or impacts like nutrition, health, or education? And again, the literature helps us answer these questions. And since we've been asking these questions, I'd like to think that financial inclusion has improved for women. But we're going to bring on a couple guests to test my own perception. So joining us today are two brilliant minds from Innovations for Poverty Action. Paul Adams leads IPA's financial inclusion program, bringing deep expertise from global financial regulators. And Daniela Grani manages IPA's work on entrepreneurship and private sector development, drawing both from policy and practitioner experience across Latin America and beyond. Welcome, Paul and Daniela.
Hi, Sonia. Great to be here.
Good to have you both. I'm so excited to discuss these insights from two of your most recent evidence briefs, which we'll link in the YouTube description for our listeners if they want to find out more information. But before we jump into that topic, we are all superheroes here working on financial inclusion. And I love asking superheroes what their origin story is. So what brought you to this space of making finance work for women? Paul, why don't you start and then we'll turn to Daniela.
Thanks, Sonia, and thanks for having us. I don't suppose my origin story is as exciting as Spider-Man or superhero. The common thread running through that story is evidence for policy, right? And I've done that in the UK, in the Netherlands, globally now with Innovations for Poverty Action. And it was actually in the UK, in the financial regulator, where I first started to kind of realize the importance of gender and thinking carefully about gender for financial services. So this was, a very specific randomized controlled trial. It was the first RCT that I'd actually been involved in myself. It was the first RCT that the FCA was running. And we wanted to improve redress rates in response to a letter from a financial services firm, basically saying, we've missold insurance to you. Please get in touch with us so we can give you your money back. And so we were testing a huge number of interventions to see what worked, to see what we could do to increase these response rates. And then one thing stood out from the results. In one of the interventions, we had the CEO sign the letter. So not a kind of generic customer services team, but the CEO. And we thought, behavioral scientists, behavioral economists, we always think this is going to signal credibility, it's going to signal importance. And so this is going to really push things forward. Mm-hmm. What we actually see is that this worked for men. It increased response rates for men, but it actually reduced response rates in women.
You're kidding.
So you got this, actually, it turns out if you average it out, basically you see zero effect of this particular intervention, but it's driven by this kind of competing effects from men and women. And I just realized, if something as small as who signs a letter is going to change behaviors, then we really, really, really need to keep gender front of mind when we're designing products and when we're designing policies. So that was the kind of light bulb moment for me, and it sticks with me today in the work that I do at Innovations for Poverty Action.
That's a great origin story. And you did mention something quite technical I want to break down for our listeners, which is RCTs, or randomized control trials. People are most familiar with this kind of research from medical trials, where you randomly assign people a treatment, which in this case was the signature from a CEO on a letter. And then there's a control group that you can compare that treatment group to. So that's called a randomized control trial. We'll be talking about that a lot in this conversation. But before we get to that, over to you, Daniela. What is your origin story?
Thank you so much, Sonia. So, well, my origin story starts in the other part of the world. I was born and raised in Peru, and most of my professional life I work in the financial sector, but both in the private and also in the public side. And on both ends, I saw the same story over and over. Women are less likely to start a business. And when they do, they face more challenges than men, and including the challenge of access to credit. They are usually asked for more collateral than men that women usually don't have. They're asked for long credit histories that they actually don't have either. So when somehow they manage to access credit, what happens is like they receive a smaller loan size compared to men. So that was quite frustrating, especially when I was working in the public side of the system, because in that moment I was in a position where I couldn't really do anything. So 4 years ago, when I joined Innovations for Poverty Action, I was happy and excited to be able to work on this space where I can, at this point, I feel like I not only understand better the problem, but I understand better what we can do about it, because that's what Innovations for Poverty Actions it's about. We rigorously test through randomized control trials what works and what doesn't work to improve people's life, and in this case, to improve women's access to credit.
Something you said was really important, and that is that research helps us understand better what we can do. I think a lot of people think of research and they think about a report just sitting on the shelf or something that you can Google and learn more. But I think in this case, we're really talking about research that is catalytic in helping us understand what we can do next to improve things. And so I'd love to jump right into your research. Paul, your recent report, Designing Credit Products to Support Women's Economic Empowerment, highlights the power of things like non-traditional data, mobile phone records, psychometrics in credit scoring maybe. What makes these innovations particularly promising to closing the gender credit gap? So, Paul, we'll start with you, and then I'll add Daniela into the conversation to add some context from her side.
Sure. Look, I think sort of traditional models of lending often just don't work in these markets. So they're reliant on collateral that is often land or real estate that is not in the woman's name. They rely on a credit history that, just as Daniela said, that doesn't exist for many women, or they rely on salary pay slips, which may or may not be available for these women who are trying to run their own business. And so these traditional models really just don't fit for women in these markets. And so what you just mentioned, these kind of alternative models that we can use, they're really trying to do two things. One is to bring alternative sources of data, right? Historical data that gives us sort of some sense of the financial position of the business. So it could be mobile phone records, which you mentioned. It could be cash flows in the business, which is recorded on some kind of digital payment device. It could be restocking information from a supplier. And you can think of all of these as helping to build a picture of the income or the revenue flow and the earnings potential for this business. And then that's really important information that, arguably should be used, but certainly can be used when businesses are deciding whether to lend.
Because you can't just give people money. Like, you have to make a decision based on something that predicts their creditworthiness. So like you need something. Yeah.
Right. Like these, banks are money-making firms, right? They're firms in themselves. They have to generate a revenue. They do that by lending to people and hoping they're going to pay back at the interest rate. Some people don't pay back. And you need to work out which are the good risks, let's say, who are likely to pay back, and which are the bad risks who you don't want to lend to. If you don't have a credit history, it's often very difficult to work out the difference between the good risks and the bad risks. And so these alternative sources of data can offer, a new avenue for lending and a new avenue to assess credit risk. I think the really, perhaps even more interesting, rather than just replacing one historical data set of credit files with another sort of historical data set of, let's say, transaction records, we can actually think of adding new information to that credit score by using psychometric tools. So these are tools that, when calibrated properly, can assess resilience, persistence, entrepreneurship, risk-taking, and all of these start to add even more information for those lenders to decide on who's a good risk, which businesses are likely to grow the most, and who's a bad risk, who's going to fail to repay that loan. So I think these are the kind of two big advantages in sort of alternative credit scoring. And I think, Daniela, there are a couple of IPA studies on this, and maybe you can say a little bit more.
Yeah, thank you, Paul. Yeah, I have a couple of studies. One is an IPA study, and the other one is a non-IPA study. So on the first topic, Paul was mentioning that using alternative data, we have this IPA study in the Dominican Republic, led by Paul Gerler, Laura Chiora, and Sean Higgins. What they did is they used machine learning techniques and they combined them with alternative data that, like mobile cell phone records. And they created this gender differentiated credit scoring that actually approved 1/3 more women than a traditional credit scoring would have.
Amazing.
Yeah, it was a huge impact. On psychometric tests that also Paul mentioned, we have this study in Ethiopia by Salman Alibai. So what they tested is they replaced the need for collateral by a 45-minute psychometric test. And just that allowed women to double their access to credit and actually reduce almost in half firms' closure even 3 years after the intervention.
Wow. And I want to explain the machine, like you went over it really quickly. So I just want to go back and dig into a little bit the machine learning alternative credit scoring. My understanding is they had the data on customers. They used a machine learning technique and they tried the machine learning technique on the whole group of like everyone, men and women together. And then they tried the machine learning technique on women and separately on men. And that's where they were able to actually approve more women because it recognized that women's and men's behavior and therefore their data patterns are fundamentally different. So you can't necessarily just lump them all in a group and expect women to have the same outcome, similar to what Paul was talking about with that signature on the letter, making a difference for women and also making a difference for men. People behave differently. Yeah. And Paul mentioned something which was the lack of collateral being a really important thing to keep in mind. Women are less likely to have collateral like land, for example. And Daniela, I wanted to dig into something I know you've done, which is research on asset-based financing. So you found in Kenya that offering, I have to read this out because it is so unbelievable. Offering a large water tank as collateral increased loan uptake by 40%. Like I wouldn't necessarily connect in my mind water tanks and lending. So tell me a little bit more about that. And why is collateral innovation such a game changer for women?
So Sonia, it was actually 40 percentage points that it can be more than just 40%, but
40 percentage points. That's important. Yeah.
Yeah, I'll tell you about it. This was an IPA study. It was led by William Jack and other researchers. Super interesting. It took place in a dairy cooperative setting where farmers are usually required, if they want a loan, they're usually required like large down payment or like very strict guarantees, requirements to be able to access loan. But in this study, they were told, okay, we're going to give you this loan to buy an asset. The asset was water tank, and you don't have collateral, so you're going to use this asset that you're buying with the loan that we're giving you. That's going to be the collateral. So that only increased access to credit in 40 percentage points. It went from 2% to 42%. And
Whoa.
yeah, it was a huge impact. We don't usually see that large of impacts in this field. So it was shocking in a positive way. And also it had very low like default rates because the bank didn't have to. The bank only repossessed the asset in less than 1% of the case, meaning if you don't repay your loan, the bank can be like, you know what, because the asset is the guarantee, I'm just going to take it. But that happened only in less than 1% of the cases. So that was huge. And obviously the water tank also have other effects, like positive impacts on the farmers' lives. Like obviously they had more access to water. The children had to spend less time collecting water, so they were, especially girls, they were able to be enrolled like in school more time than they would have if they didn't have this access to water. So in short, I think like two things. This is a big innovation because they remove this collateral gap that usually exists for women. Women don't usually, as you mentioned, they don't have access to land, they don't have access to like big assets, at least not on their names. So the fact that they can now get a loan to purchase this asset and then collateralize the loan with the asset that they're buying, it really levels the playing field for them. On the second point, it's also a very profitable product for the lenders because at least in this context, the default rate was very, very, very small. So it was good for them. It was good for women that were able to access a loan that they wouldn't have in other circumstances. And we move from this equilibrium of no collateral, no loan to a system where both when lenders have a profitable product to offer and women who wouldn't have usually access this type of credit because of lack of collateral, now they can. And at Innovation for Poverty Action, we keep working on this. And actually, currently, we have this ongoing project in Pakistan with some researchers are going to offer this asset-based financing option to women to buy rickshaws so they can enter this more male-dominated transport sector in that country. So yeah, we keep working on it.
And now a word from our sponsor. EY applauds Women's World Banking's 45-year legacy empowering women through financial inclusion. Together, we have a common vision to build a better financial services industry, one that is stronger, fairer, and more sustainable. Find out more on ey.com.
That's amazing. And I think, like, if you were to ask me what the relationship is between water tanks, loans for women entrepreneurs, profits for financial institutions, and girls going to school, this would be like a party game where I wouldn't actually know the answer. Like I'd have to make up something. But it is incredible to hear these linkages that are not actually spurious, that are truly related to one another. They're not just randomly happening at the same time. They're actually related. And what a strong answer to that question I posed at the beginning, which was like, under what circumstances does credit work for women? Under the circumstances in which they have the collateral to get a sufficient loan size, under the circumstances in which that collateral is also doing something else for the family, like reducing the amount of time spent gathering water, putting girls in school. It's really exciting.
So we've talked a lot about women's access to finance. I'd love to shift towards talking about the internal process at financial institutions. One thing we talk a lot about at Women's World Banking is bias and the potential for bias across both traditional models and also other models that are innovative as well. Daniela, you've done some work on bias and have found really startling findings from Chile about persistent bias among loan officers, even after training, which is something that's really concerning for me. What do we do when education alone isn't enough? Like, how can financial institutions reduce bias against women?
Yeah, that's a great study in Chile. It's actually an IDB study, and it's led by Ana Maria Montoya and other researchers in the IDB, and it really showcases the reality of gender biases in the Chilean financial system. So, as you might remember, like in the study, they describe this bias as a taste-based bias, which means that these biases arise only from personal preference. It's just like they don't like female borrowers and that's it. So that's very hard to unlearn. You cannot teach someone to like another person, or you cannot teach someone to change. So what you can do in a situation like that is you have to change the system around it. You know, like hiring policies, incentives, transparency. Those things might work. We're still testing them, and maybe I can talk about three specific things that can be done by financial institutions when you have an environment like this. The first one could be hiring policies. So when financial institutions are screening for potential credit officers, they can just run simple tests, like implicit bias tests, to see if these officers are pro-male or pro-female, and identify them in that first stage. So, second thing could be payments and bonuses. So in the study, you can see that a lot of money was left on the table with these rejections that were based only on biases. The researchers even they estimate how much the banks lost because of these biases. So if financial institutions are able to link payments to the return of the portfolio instead only to volume, they might align incentives for credit officers to have a more balanced portfolio, like a gender balanced portfolio. And a third point, I think, is a little bit what Paul was talking also about algorithms. We can have a gender neutral algorithm to be this first filter. So women are not rejected since the beginning. So before the human biases come in and reject it, we can have these to pre-approve or approve women. And the only thing that we can hope is that the algorithm is not biased as well. So we have to create a gender neutral algorithm. So I think there's probably more things that can be done, but those three things are somehow being tested at this point to try to address the challenge.
So hiring practices and like screening out people who might have implicit biases that are going to affect their performance in terms of assessing women borrowers. Bonuses to incentivize good behavior. So you talked about like the carrot and the stick before, we've talked about that before. And then kind of introducing a more objective algorithm before the human takes over. And of course, algorithms can also show bias, like we talked about with the Dominican Republic example, but algorithms are more easily able to be controlled. And so we can actually use AI and machine learning techniques for inclusion and kind of monitor them. I think those are really pragmatic suggestions. And those things might actually be less expensive. I'm looking at them, less expensive to implement than training over and over, training your staff over and over, which can be really time and resource intensive. So those are really, really easy and practical suggestions for reducing bias among loan officers. So we've talked about access. We've talked about bias in the process. Now I'd love to talk a little bit about disbursement methods. Disbursement means how people actually receive a loan. So I could walk up to somebody and I could give them cash and I could say, you need to repay me this cash plus interest. There are other ways of dispersing, though. You could get a disbursement into your bank account. You could get it over mobile money. Like there are lots of ways of delivering money. This might sound boring, but in fact, from Uganda to India, Paul, you've found that giving women control over loan funds and dispersing digitally actually improves profits and household resilience. I need an explanation. I'd love to hear more about that.
Yeah, absolutely. And honestly, like, I've worked in financial services for 10 years. Like, disbursement is boring, but what it can do is really exciting, and so that's what we're going to talk about and focus on. And you've explained very well, like, these different disbursement methods. I think first off, in the markets where we're working, often cash is the dominant form of disbursement method, and evidence from multiple countries has shown that women, when they're dispersed in cash, they do end up sharing some of that business loan within the household, especially if there's another business within that household. So, okay, they're getting loans in cash and they're having sort of social or family pressures to use it in ways that they hadn't intended. So, by definition, just depositing that loan into a digital account in that borrower's name gives them a little bit of privacy, right? There's nothing physical. There's no wad of cash on the kitchen table when they come back from the market. And so that gives women the privacy they need, and it reduces the social pressure from spouses. Now, even if you have a nice, friendly, good, positive relationship with your spouse, even if you sort of say, okay, I've got a loan, it's digitally in my savings account, just having that extra step, that extra bit of friction to say this is in a different account in my name, that there's this extra step they have to take in order to transfer it, that also gives women an extra moment in the household with which to sort of bargain and hopefully keep that cash, keep that loan for their business. And so this additional privacy really works. So Emma Riley and Rachel Heath have a wonderful study in Uganda, and they find that automatically depositing those loans into a digital account in the woman's name is good for all participants, right? So this is an RCT. We're comparing people who get a loan dispersed in cash versus a loan dispersed into their account, and all women and all businesses benefit. But what was most striking is it's most impactful for the women that, when asked before the study whether they were tended to be pressured to share resources in their household, for these women, it was especially impactful. So they experienced a 25% increase in business profits, similar increase in business capital. So this meant the money for these women, which normally they'd be under pressure to somehow use it in other ways for the household or for their spouse's business, they're putting all of that money now into their own business, and that's having an impact in terms of business profits. And so it is about power, right? This privacy is giving people power. It's the power to decide how the funds are spent in the household, but it's also the power to invest in their own business and to make it, as you said, like with your example of the dressmaker, like to expand their own business and to grow. And so that's a really nice example of just loan disbursements. But we also see this kind of effect in other ways. So in village savings and loan associations, or SACCOs, you see these savings groups all around the world, different forms. We see that women who join these groups, these saving groups, they're able to have more say in household decision makings. So this is, again, just bringing women into the financial sector, savings groups, lending. It's giving those women an opportunity to have more power and more say in households.
That's so important. More power, more control, more access to resources. And also, this is an important point, disbursing money through digital means is less expensive for a financial institution and more easily tracked than dispersing in cash. And so there's that element as well. Like there's a business case for this, just like Daniela was telling us about repayment rates. So using collateral, like it actually increased repayment rates And so this is not charity we're talking about. Like, it's actually good for financial
Absolutely.
institutions too. Yeah. I have one more question for you both. Rapid response. If you could redesign one element of credit policy or product design to move the needle most for women entrepreneurs within the next 5 years, what would it be and why? Daniela, you first.
This is a very tricky question because there are many things that I would like to change, but I guess
Rapid response, Daniela. You got it.
I think it would be gender biases, because I think it's an invisible filter that takes women out of the game before they even have the chance to start. And it's also women get stuck in this vicious cycle because with the gender biases, they cannot access credit. If they cannot access credit, they also will never build a credit history. And credit history is also one of the reasons why women can't access credit. So it's an impossibility for women. So I would try to work around gender biases, if possible, eliminate them, but at least work around them.
Good answer. Paul?
By the way, you should never ask a researcher for a rapid response.
That's true. It's unfair.
I think my one is I'm gonna place my bet on alternative data for credit scoring. I think there's so much good work happening in the space right now, and I think it's only going to increase over time, right? So, like, we're all part of this kind of digital revolution. We've all been there the last 10 or 20 years, seeing our digital footprint expand and expand and expand. And that's happening right now in many of these markets as they move to digital services, but also the digital economy more broadly. And that's going to be a game changer. If you can start to use that digital footprint, then I think this is the new way of making credit decisions. And I think it's going to unlock a lot of doors.
Yeah. It's huge. It's going to open up a lot of possibilities in the credit space. And I, too, am looking forward to seeing that happen. Well, thank you so much, Paul. Thank you so much, Daniela, for your conversation today. This was a delight.
It's been great. Thank you.
Thank you. Thank you for having us.
Well, as we close, I, as always, have a lot of notes, not only about the connection between water tanks, women's access to credit, profit for financial institutions, and girls going to school, but also notes about alternative data, about bias against women, and like the very practical research-based suggestions for how to reduce bias, collateral, and the importance of that. Policy, that was something that we touched on as well, and how even like little changes, little very inexpensive changes can make things different for women. At Women's World Banking, we've seen time and again that access and usage data when you're designing for women helps us design for everyone. So to any loan providers listening out there, we have the perfect tool for you. That's our Digital Credit Activation Toolkit. It's a publication designed to empower financial services providers to refine and enhance their digital credit solutions to better serve low-income women, particularly micro-entrepreneurs. Providers will be equipped through this toolkit with strategies to design and implement initiatives that are aimed at improving access to credit for women, addressing the unique challenges they face in securing financial support. You can find it by looking up Digital Credit Activation Toolkit on our website. We'll put a link in the chat below. We'll also put a link to the studies that we talked about today, which I think are important. And if there's anything you heard today that you really want to dig into, I would highly recommend a further look, or honestly, just like reaching out to Paul and Daniela, who are excellent resources and very available online. You can find them on the Innovations for Poverty Action, or IPA website. If you found today's discussion valuable, please don't forget to subscribe, rate, share it with your friends and colleagues, leave a review for us on your favorite podcast platform, or you can do my recent party trick, which is, can I see your phone? And then sometimes following or subscribing to the podcast on one of my relatives' favorite podcast apps. Your feedback really matters to us. It helps us bring us the content that resonates. So please stay engaged, stay informed, and I look forward to seeing you next time.